IDFC Nifty 200 Momentum 30 Index Fund. Will this NFO add more risk to your portfolio, or will it help you increase your overall portfolio return? Let us evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision so that you can reach your financial goals faster and smarter. First, let us understand some key features of this particular NFO, and then let us understand this index in detail. Then we will analyze this particular fund. The NFO is open till 26th August 2022. The benchmark index is Nifty 200 Momentum 30 Total Return Index. There is no entry or exit load. Minimum investment amount is 5,000 rupees. Fund manager is Nemish Sheth. The investment objective of this fund is very simple. This fund will mimic, replicate the Nifty 200 Momentum 30 Index. Here the fund manager will replicate the same set of 30 stocks in the index in the same weightage. He will aim to deliver similar returns of the index subject to the tracking error and expense ratio. This particular index follows something called momentum factoring method. Based on the momentum score, out of Nifty 200 basket, 30 top stocks are chosen based on the normalized momentum score. How this normalized momentum score is calculated? It is calculated based on the 6-month and 12-month price return adjusted for its daily price return volatility. So price return and price return volatility is a observable data. Based on that, they will select top 30 stocks out of Nifty 200 and they'll construct this particular index. The momentum investing. What is factor-based investing? Actually, momentum index is a factor-based investing method. In this factor-based investment approach, they will involve few drivers which will decide what kind of stocks to pick and choose. So based on the specific drivers which are observable data, it can be stock prices or some financial information. It will not be opinion or speculation. So based on an observable data, momentum score is calculated, or some other score like value, enhanced value, alpha can be calculated. Based on that particular factor, stocks for the index is selected. This is what known as factor-based investing. What is momentum investing? Momentum investing is built on one simple premise. Stocks that have gone up or down will continue to go up or down, at least in the short term. Here, this particular approach strongly believes that price is the king and it is the true reflection of the investor sentiments towards the stocks. So predominantly, momentum investing tries to capture the sentiment of the investors by chasing the trend in the market. Now we have understood what this NFO is all about, and now we will spend some time on analyzing this particular index, because in this particular NFO there is no track record, there is no portfolio. Being an index fund, track record or a portfolio is not required. If we analyze the index, that itself will give a fair idea. This particular index is spread across multiple sectors ranging from power, oil, gas, capital goods, automobile, chemicals, consumer services, financial services, FMCG, metals and mining, telecommunication, healthcare, consumer durables, textiles. However, top 4 sectors, power, oil, gas, capital goods, automobile and auto components, these 4 sectors amounts to 50% of the allocation. So in the overall assets under management of this particular NFO will be invested only in this 4 sectors. 50% of the AUM will be invested only in 4 sectors. So there is a sectoral concentration in this fund. Concentration can add more risk. At the same time, they have got the potential to add more return also. We have to wait and see. Top 10 stocks are Adani, Titan, Sun Pharma, ITC, NTPC, Tata Motors, Mahindra and Mahindra, SRF, Tata Power, Power Grid. One good thing which you can easily notice is top 10 stocks have around 5% of the overall assets. So the weightage is only 5% for each of these stocks. So though there is a sectoral concentration, in stocks wise there is no concentration. There is enough diversification. Sector wise also they are diversified across multiple sectors, but they are concentrated to 4 sectors. But as far as the stocks are considered, they are well diversified actually. The past return of this index, total return index, is what we have to focus. In this calendar year, this particular index has delivered 13% negative return. In the last 1 year, this index has delivered 3.38% negative return. However, in the last 5 years, this index has delivered 14.92% annualized return. So being an equity fund which is diversified across multiple sectors and multiple stocks, it has got a potential to deliver inflation beating return in the long run, like 5 years or 7 years kind of time frame. However, in the short run, being an equity fund will be volatile, can deliver negative returns in the short run. If you have got short-term money, short-term goal, then this fund is not suitable for you. We have understood the key features of this NFO. We have also understood the index in detail. Now, when we researched this particular fund in detail, we came across few positive observations on this fund. Let me give you those positive observations first. This index has got a diversified portfolio across various sectors. So the portfolio will not be a concentrated portfolio. This fund has got the potential to systematically add relatively performing stocks and remove relatively non-performing stocks based on a predefined criteria without any human intervention. This fund is free from the fund manager bias. Normally in the actively managed fund, the fund manager will pick and choose the best stocks, and the fund manager will avoid below average stocks. By this, he will be trying to generate alpha. In the process, if his judgment and calls go wrong, he may be delivering poor returns, right? This is what known as fund manager bias or stock selection risk. Being an index fund, IDFC Nifty 200 Momentum 30 index fund doesn't have that risk, because here the fund manager is going to simply mimic the index. He is not going to select any stocks. He is going to replicate whatever is given in the index in the same weightage. Being a diversified equity fund has got the potential to deliver inflation beating return in the long run. Being an index fund obviously will have low expense ratio because there is no fund management expenses. Here the fund manager is not going to do any analysis, no research. He is going to simply replicate the portfolio. So there is no fund management expenses. That way, the overall expense ratio will be considerably low. We have completely analyzed what are the positive factors in this fund, and now it's the time to focus on what is the negative observations on this fund. Because being an investor, you need to equally focus on the risk factors, threats for this fund. Many a times we tend to over focus on returns, positive side, and we tend to go out of focus in the area of risk that needs to be avoided. This fund is not suitable for your core portfolio. Conservative investors, beginner investors should consider broad-based index funds or well-diversified large cap funds. Momentum style is an aggressive style of investment. So it is relatively riskier compared to a well-diversified portfolio. Momentum can change anytime. That is why we call it as a riskier proposition. Being an index fund, it is not having any capability to beat the index. Here, the agenda itself is to replicate the index and deliver similar returns, not to outbeat the index. In the actively managed fund, because the fund manager will choose the best of the stocks and give better allocation to sectors where they have better outlook. All those things are possible. Because of that, the fund manager will be able to deliver better alpha in the actively managed fund. Being a passively managed fund, this index fund is not capable of giving you index beating returns. Fund manager will not be able to change the portfolio based on the market outlook. If the market is bullish, giving higher allocation to small cap and the momentum stocks. If the market is bearish, giving allocation to defensive large cap stocks. This kind of dynamic management is not possible in this fund. They have to simply mimic the index. Here, the fund manager will not study the stock's background. What is there in the balance sheet? How is the profitability? What is the sustainability, capital efficiency, value proposition, competitive edge? Nothing will be analyzed. Even if there is a sector where the outlook is very poor, even if there is a stock which is a poor performing stock, the fund manager is forced to give allocation to that sector and that particular stock because it is simply there in the index. So obviously here the fund manager is forced to blindly follow the index. So he is taking blind risk. He is not taking calculated risk. Normally in the actively managed fund, the fund manager will calculate, analyze, do the research and take calculated risk. Here it is not possible. When you take calculated risk, your downside risk is protected and your margin of safety is increased. Here it is not possible. I strongly encourage my investors to focus on taking only calculated risk and completely avoid taking blind risk. One of the drawback of index fund is tracking error and expense ratio. Because of that, these index funds will deliver less than the index return. This fund is not flexible when the market is correcting, when the market is touching all-time high, all-time low. Fund manager will not be able to make any changes. There is no flexibility. The fund is very rigid in the mandate. They have to simply mimic the index. Being a momentum theme fund, right? This fund's factor is momentum. So they will be simply chasing the momentum and the momentum can reverse anytime, right? If particular sector is bullish and this particular factoring method, this approach assumes that the same outlook will continue, but that outlook can change anytime. Suddenly Russia-Ukraine war happens and because of that trend reverses. When the trend reverses, this particular fund will have a huge drawback. This fund will go through a period of relatively underperformance when there is sharp change in the market cycles, like sharp recovery, sharp drop. So when there is sudden U-turn in the market, this fund will give you huge underperformance. We analyzed what are the positive factors and what are the negative factors. So finally, can we invest in this fund or not? If you are a beginner investor, if you are a conservative investor, if you are someone who is looking for a fund for your core portfolio, you should avoid this fund. If you are an aggressive investor, then this can be in your consideration list. If you are looking for dynamic fund management, this fund is not suitable. Actively managed funds have got the better potential to deliver higher return than this fund. There are similar index funds with less expense ratio and less tracking error. Proven lesser expense ratio and proven less tracking error. Then why should we take blind risk when you invest in this NFO? We are not sure what kind of expense ratio, what kind of tracking error this fund will have. So we are taking blind risk from that perspective as well. If you are looking for market beating return, this fund is again not suitable to you. Before deciding to invest in these kind of funds, please consult with your financial planner, because financial planner knows your entire financial roadmap. He knows what are all your major financial goals in the roadmap. For those financial goals, for those investment objectives, whether this fund is suitable or not, he will be able to analyze and advise you. First thing. Second thing, based on your risk appetite, based on your capacity to take risk, whether this fund is suitable to you or not, he will be able to analyze and tell you. Number three, because you are adding this particular index fund to your portfolio, what are all the unique stocks you are going to add to your overall portfolio? You already have set of mutual funds, you already have set of direct stocks. Because you are adding this index to your portfolio, is it going to overlap your existing portfolio? Is it going to bring additional unique stocks, hence additional diversification? That a financial planner will be able to analyze and let you. So consult your financial planner before you deciding to invest in this fund or before you deciding to avoid this fund. Hope you like this 360-degree analysis on this IDFC Nifty 200 Momentum 30 Index Fund NFO. If you have any further questions on this fund or any other investment options, feel free to book a free appointment with our certified financial planner. Our certified financial planners are available to you, discuss with you anything related to achieving your financial goals. To book the free appointment with our certified financial planner, the link is given in the description. I have also given another link in the description where you can register for our upcoming webinar for completely free. We regularly organize insightful investment webinars with industry experts who have 15 to 20 years of experience. They will share their wealth management strategies and investment techniques. You can discover those strategies and techniques and apply to your portfolio immediately. You can register for the upcoming webinar and participate and discover the strategies to create wealth. Hope you like this video. I'll again meet you in yet another useful video. Bye-bye.